Welcome to our session in financial management for beginners, chapter one. So in this class, we basically want to understand what financial management is and also look at how to calculate the time value of money. So basically, in this introduction, we should be able to understand the objectives that financial managers have, which is profit maximization and wealth maximization. These are two different things. And the functions of the financial managers, which come in four um, important aspects. So the roles of financial managers come in four aspects. We have what we call investment decisions. We also have what we call financing decisions. We also have what we call um, so these are the main roles that financial managers have. Just to expand it a little, financial managers play a significant role in every business because their knowledge of profit maximization and loss maximization should be on behalf of the owners of the businesses who are the shareholders. So what are these investment decisions? So the investment decisions basically will be looking at decisions where they'll be deciding on how to allocate funds to maximize returns, investments which will include long and short-term projects, and evaluating their cash flows. So from this role, we're going to learn how to calculate the NPV, understanding whether a project is worth undertaking or not. The second role of financial managers is that of making financing decisions, looking at the capital structure. So we will look at questions to do with how um, the best mix of a firm can be done. How much of debt, how much of equity must be used to fund the operations of an organization. So we should understand that if there's too much equity or too much debt, the balance is not well mixed, the company may not really perform better. So the financial manager must actually evaluate the cost of capital. So we understand how to calculate work, how to calculate financial risk. Then also dividend decisions where we're going to determine how much profit can be distributed to the shareholders versus the expected future returns. So it is in this course where we'll learn how to calculate the costs of stock. We should also look at the agency problem that arises between managers and shareholders. We know that managers are employees, they're agents who work on behalf of the owners of the business who are the shareholders. So the agency principle problem arises where managers would have to balance being directors or managers or agents. Um, so sometimes managers will pursue personal goals like giving themselves higher salaries, having job security at the expense of the shareholder whose main interest is to have a return which comes through a dividend. So we have what we call the agency problem. So managers are actually employed to act in the best interest of the company. But of course, most managers, whenever they are running a business, they would opt to go for profit than borrow money because money has a cost. So the urgency problem usually arises when there's a conflict between the interests of the managers and those of the shareholders, because managers usually would want to pursue their personal goals. For instance, a manager might avoid a high risk or high return investment that will benefit the shareholder due to fear of what? Losing their job. So in this context, we need to understand effective financial management. It requires you having mechanisms like performance based incentives, corporate governance policies. All these should align to managerial decisions. So now, what is the role of financial um, markets? So we will also understand that there's a mechanism through which firms will play, and the platforms that are there are what we call financial markets. So these ones are there basically to link firms and investors. So question in that chapter basically as follows. Number one, define financial management and explain the major objectives. So financial management has two main objectives. These are exam questions. The first one is that of profit maximization. So profit maximization assesses that looks at short-term earnings. The other function is that of what? Wealth maximization. Is there a difference between the two? Profit and wealth maximization, according to you? Do you see any difference between profit and wealth maximization? So when we're dealing with profit, we are focusing on increasing what? The earnings over a short period of time. Profit maximization is mainly concerned about you maximizing operational efficiency. For instance, if you're running a company, a retail company, you want to focus on the festive season, so you have to maximize profits during Christmas. So you're going to focus all your efforts based on having to maximize the profit in that period of time. Whereas wealth maximization is usually long term. You are focusing on increasing the value of the firm or wealth for shareholders. It takes into account issues of time value of money. So that is the difference. Question number two, what are the three major decisions that financial managers make? There are actually four decisions. So what are the three major decisions? We have the financing decisions. What did we say about financing decisions? So financing decisions are decisions that look at the best mix of debt and equity in terms of activities. So the financial manager wants to balance up how much cost of capital must be there, cost of debt must be there, to make a mix that will facilitate the expansion of a company. So managers also make what we call investment decisions. This is capital budgeting, where you're going to allocate a firm's funds to generate maximum returns to increase the shareholder value. So here it looks at evaluating long-term projects like buying new machinery or expanding into new markets. Financial managers also make what are called dividend decisions, looking at the payout policy. So they usually focus on how much profit can be distributed to the shareholders versus retained reinvestment in the business. So here, the financial manager will focus on retaining earnings that can project financial growth whilst paying dividends that will attract investors. Okay, question number three, explain the concept of urgency problem in financial management. What is urgency problem? So urgency problem, I can carry about 5 marks. So you need to understand it. So urgency problem basically is a situation that arises where there's a conflict between the managers who are the agents and the shareholders who are the principals. So here managers are employees. Their mandate is to run the business on behalf of the shareholders, but sometimes they may pursue their personal goals that may not align with wealth maximization. So urgency problems usually come about when you put in excessive perks like luxury offices, luxury cars, unnecessary travels, okay, empire buildings, risk-averse behavior where you're avoiding profitable projects because you are fearing it may affect your job security. So solutions to urgency problems, basically, you need to put in things like performance-based incentives where you're going to link compensation to performance, monitoring where you have regular audits and financial reports to have to see whether you're moving within your mandate, corporate governance, okay, where you have strong governance policies that will align with the decisions, managerial decisions with stakeholder interests. So this is a concept of urgency problem. Are we together? So now we also go to calculation of stock. So we talked about stock valuation early today in the morning. So we now need to understand how to evaluate this stock that belongs to the shareholder. So shareholder earns what we call a dividend. So there's what we call Gordon's model. Gordon's model is given by the price P0. Who remembers the formula? P0 is equal to what? D1 R minus what? G, where D1 is the dividend in year one. So if you're not given dividend in year one, you can calculate it. The D1 is equal to what? D0, 1 plus growth. So the company expects a dividend of 2 kwacha next year. So is this D1 or it's D0? The required rate of return is 12%, and dividends are required to grow at 6% annually. Using Gordon's model, calculate the value of a share. So this is a direct extract from your textbook. So how do you calculate? So this is D1, right? What else are we given? This is growth. What else are we given? This is R. So we substitute the parameters in the formula. So D1 R minus G, where D1 is 2, R is 12%, and growth is 6%. So when you substitute that, we're going to get 3.33. So this is the worth of the share. So when you calculate this, you need to understand that there's time value of money and also the evaluation basics. So you need to um, understand the currency you're using. If it's a dollar, put it in dollar because this is money we're dealing with. Okay, so what's the difference between financial management and accounting? There's a difference between the two. What is the difference between financial management and accounting? Anyone? So financial management is different from uh, accounting. So can somebody tell by now, since you're preparing for exams, you should know the differences. Accounting basically looks at recording what? Historical or financial data. It looks at issues of compliance and how to prepare statements. Where financial management, you are focusing on decision making for future investments. You're focusing on financing and creating value. So this is a 5 mark question that you need to understand. So when dealing with financial accounting, it's very systematic. You record, you report, you analyze the organization's past transactions, and you ensure that they're in compliance or in tandem with the legal requirements. So in financial accounting, we prepare financial statements like the balance sheet, the income statement, the cash flows, whereas accounting also provides historical information. Financial management, on the other hand, you are concerned with planning, directing, controlling financial resources to achieve the organization's future objectives. So basically, you are focusing on decision making, financing, and dividend policies. So the key differences are in time, purpose, decision making, scope. So accounting looks at historical data, whereas financial management looks at the future. The purpose of accounting is compliance and record keeping, whereas financial management is in what? Wealth creation and maximization of profit. In terms of decision making for financial accounting, information is just for information purposes. Mainly, it reports data, whereas financial management, you are giving strategic data that is going to help you make choices that will impact growth. And the scope of financial accounting is mainly financial statements and audit, whereas financial management, you're looking at investment decisions, financing decisions, dividend decisions, and risk management. So you need to understand that. Discuss the role of financial markets in financial management. What are financial markets and what role do they play? So financial markets are a platform where firms and investors interact. These play a very significant role in supporting financial management. So number one, they enable access to capital markets. So companies can raise funds for expansion from these markets through issuing equities like shares or debt like bonds. Financial markets are also there for liquidity for investors. So financial markets will allow investors to buy and sell securities easily. They will enable them to convert these investments into cash. Financial markets are there for price recovery and efficient resource allocation. So it is in these markets that help to reflect investor sentiment. So they help you determine um, demand and supply for the price. So they help you to allocate resources to projects with the highest expected return. Capital markets or financial markets generally are very important because they'll provide you with instruments like derivatives, which include futures, options, and swaps that will help you hedge against what? Interest fluctuations. So financial management is very important because financial managers will use this information to make decisions regarding capital structure, financing, and investment. So efficient markets are there to reduce your capital from deterioration because they hedge you against what? Unexpected inflation or interest rates. Okay. So question number 7, an investor deposits $1,000 in a bank at 10% annual interest rate. Find its value after 3 years. So its future value is equal to present value 1 plus r to the power time. So 1,000, 1 plus r. So we're going to get 1,331. This is the future value, how we calculate the future value. So these questions come in present value is the opposite. You just make PV subject. Formula for present value we covered in the previous class. PV is equal to what? Future value 1 plus R, the power time. So basically, this is the introduction to financial management. Are there any questions? All right. We proceed to chapter 2.